Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's take a look ahead to the forthcoming US jobs report taking place on Friday, the 2nd of February, wrapping up a week that sees five of the Magnificent Seven reporting their latest earnings. We see the Federal Reserve and the Bank of England interest rate decisions. And on Friday, of course, like I said, we have that jobs report. Now, there's likely to be big volatility leading into it. And so the tone and sentiment of markets at that time is going to be key. But also we have to try and gauge exactly what might move the markets in one direction or another. And hopefully these charts and this outlook gives you an idea of exactly that. So let's look first and foremost of what markets are expecting. Trading economics pointing towards a 175 figure on the payrolls number. That's down from 216 last time. So quite a strong reading last month in December. Unemployment rate expected to remain at 3.7%. But if you look at the bottom, the U6 metric, which essentially is total unemployment, which also includes people that have stopped looking for a job, essentially, that's expected to rise to 7.3 from 7.1. The reason for that, in part, is this expected decline in the participation rate. Also, we've got the average hourly earnings expected to drop down to 4% from 4.1%. So that's welcome if we see a continued disinflation pathway. And that comes thanks to a move down to 0.3% from 0.4. Of course, generally, when we see volatility, it's from something that is different from these expectations. So we want to try and see exactly what markets might need to see within these figures to really provide a threat to the US economy and the sort of safety of the so-called soft landing narrative. Here's a few charts I want to show you. First and foremost, we have a relationship between the likes, as we see on the top, of the job openings numbers from JOLTS, the unemployment rate reading, and the core CPI. I've also got the payrolls on this slide as well. So top section of this essentially shows you in the light blue, it's inverted, but essentially shows you that unemployment is essentially where it was prior to the pandemic. It's been flatlining. We haven't necessarily seen any significant uptick in unemployment, despite these two other metrics, such as job openings, such as the core CPI, which in the past have been correlated. Certainly that decline in the job openings has been notable, but we have seen a relatively decent figure this month. Also, in terms of the payrolls figure, I mentioned we saw a relatively strong reading last time around, over the 200K mark. The downtrend that we can see here over recent years really comes into question, and people start saying, well, look, we're seeing payrolls decline, and therefore that's a sign that the higher interest rates are really having a negative impact on the economy, and the Federal Reserve's going to need to do something. Well, as you can see here, this band that I've drawn on, essentially, we're back within the range that was seen prior to the pandemic. We're in a relatively normal range, and certainly with unemployment at the level that it is at the moment, you're not necessarily likely to see huge payrolls numbers when we see unemployment relatively low. So at the moment, I wouldn't necessarily say that it's too much of a worry for the Federal Reserve. The bottom end of this band that I have, this sort of grey shaded area, is around about the 100K mark. So if we start tracking back towards that lower level and start regularly hitting 100K, sub 100K, then yeah, it's a potential problem. But as things stand, unemployment remains not an issue. The payrolls remain not an issue. So I think ultimately, if we see unemployment remain as is, which is expected, if we see the payrolls numbers relatively strong, and 175 is a decent number, then I think that it really does provide a narrative that the Federal Reserve might be happy enough to hold off on that March meeting. In terms of the next slide, I wanted to show you the relationship between unemployment, which is essentially the green line, and I've split it up between sort of newly unemployed people and those that have been unemployed for some time. But then also tagging that onto the conference board, hard to find divided by plentiful ratio. Essentially, do you find jobs hard to find at the moment or plentiful? And as that ratio changes, in the past, it has been a relatively decent predictor of where unemployment might go. That is notable because this time around, we've seen a particularly strong Conference Board consumer sentiment survey, and this ratio has moved markedly. Certainly, it seems like the tightness within the jobs market is easing somewhat, as you can see here, with that decline in the purple line. And it really starts to sort of ease off on calls for a potential rebound in unemployment. You could argue that we could see a rebound in the U6 measure, like I said, um, but ultimately that rebound in U6 might be a case of people coming back into the workforce after a period out of it and then looking for a job. As it stands, I don't necessarily see anything here that points towards a significant rebound or a reason for the Federal Reserve to worry per se. Bringing back a number of factors, that jolts job openings once again on the bottom, alongside that hard to find divided by plentiful ratio, both telling a similar kind of story here. But let's just start on the top end. That initial claims and continuing claims jobless figure that we're seeing on the top end, neither of them are seeing a significant uptick. So we're not necessarily seeing anything that's too worrying on that side either. That's a precursor, of course, to this jobs report. So none of these figures on this chart are going to be seen on Friday. They've all been seen in advance. And so we don't necessarily see too much to worry about here. The JOLTS job openings number has been declining of late, and that has been a concern, but we've actually seen a stronger reading than expected this time around. And the rebound in that hard to find divided by plentiful ratio has essentially started to roll over as well. So again, another couple of signs that fill us with a bit of confidence, or certainly the Federal Reserve. And then finally, coming on to average earnings, you can see here the core CPI, which is the purple line, and the blue line, which is the average hourly earnings on a yearly basis, essentially tracking together recently. 4.1 expected to drop down to 4%, as I as I mentioned earlier in the video. And so this, whilst it's a relatively slow trajectory towards the downside, does point towards an easing of wage pressures, but relatively elevated by historical standards. So we're hoping to see this come down further. If you look at where we are in terms of the 3-month annualized, to give you an idea of where wage growth is compared to historical standards, we are a little bit above that band that I have drawn on at the bottom, which would be the sort of pre-pandemic level for wage growth. So wage growth still a bit too high. The Federal Reserve might see reasons for them to remain somewhat patient to try and drive down these underlying inflation pressures. And like I said, across a number of these different metrics in terms of the strength of the US jobs market, I don't necessarily think there's too much to worry about right now. We don't necessarily have too much in terms of a warning sign to look out for. Let me just show you exactly how things stand in terms of some of the charts. So bear in mind, I think there's more of a risk that we come out with something that is relatively strong in terms of the economic side of things, and that the Federal Reserve are essentially going to feel like they can hold off for the time being and not cut in March. I don't necessarily think there's going to be much from this release that will tell us we're going to see the Federal Reserve desperate to cut as soon as possible. And so that points towards a potential risk off play, which would benefit the US dollar. The US dollar has been gaining ground of late, but recently moving into this sort of consolidation zone. You can see here, just consolidating over the past couple of weeks, really, as it tries to find its feet. In terms of this wider daily time frame, we can see that we're trying to regain ground, but this wider sell-off that we've seen over the past few months does pose a risk. So if we were to start breaking down through some of these, key levels like 102,770, or certainly over the nearer term, this 103,147, then you've got a bit more of a risk. But I think there is a good chance over the near term that just how we're starting to see these higher lows come into play, I think there's a good chance that we do see around about this jobs report the potential for something that doesn't necessarily put off the Federal Reserve, and the possibility of a near-term bit of strength coming into play for the dollar index. The caveat here, of course, is the fact that we have the Federal Reserve ahead of it. We have a number of big tech earnings ahead of it. So if we're seeing some risk on play, that's likely to drive down the dollar index over the near term. But I think around about this around about this release, there's a good chance that we do see a bit of a risk off move, which could benefit the US dollar. Over the long term, though, the medium to long term, I do think that markets are going to get their rate cuts and set us on a path that is likely to be strong for US equities. It's an election year as well, which generally is good for equities. So I do think that would lead to downside for the US dollar. But there is a risk for this upcoming jobs report that things look relatively hunky-dory and that we're going to possibly see the US dollar coming in for a bit of strength. In terms of the S&P 500, this is a market that has certainly been on a bit of a tear recently, rallying up into fresh record highs of late. And so, like I said, given the fact that we've got those tech earnings this week, a lot of that sentiment is going to be driven by the strength of their earnings. But over the near term, given this sort of overextended move towards the upside, if we were to see some strong jobs data coming out and a FOMC meeting that essentially says, we're willing to hold off if necessary to drive down wage pressures and inflation pressures, because I don't necessarily think we're going to see CPI anywhere near 2% over the coming months, so certainly by March. The same goes for the core PCE. I think there's a good chance that we do see them hold off. And if we see strong jobs data, we could see a bit of a pullback over the near term. We would need to break through the nearest swing low to really point towards the possibility of us seeing a wider pullback coming into play, and in which case 4881 for the time being is exactly that swing low. But like I said, we've still got a few events in the meanwhile to let things really start to progress. But in terms of what's going to make us think that we're going to see a rate cut in March beyond what's said at the FOMC meeting, I just don't see it, because we're not necessarily seeing any major uptick in terms of unemployment. The payrolls numbers were strong last time. There's a good chance that we see something mid 100s, but that really is just an average kind of figure for where we are in terms of the economy and in terms of the long-term area that payrolls are. And the wage figure is moving lower, but very slowly. If it moves to 4%, how long is it going to take to get back down to previous levels? So I think there's a good chance of a risk-off move to end the week. But the caveat here, of course, is that from a wider perspective, everyone wants to buy the dip. So that risk-off move might not necessarily be the most long-lasting move you've ever seen in your life if it comes into that and if we see some strong numbers. But certainly it will wrap up a week that should give us a good idea of exactly how things are going to look moving into February. And certainly with the rest of earnings season to look forward to, there's a good chance that this week essentially will set the groundwork for how markets feel and I think probably take away some of the volatility that we see throughout the rest of earnings season. As long as the tech stocks are doing well and as long as people think that we're going to see the Federal Reserve cut rates soon, then everything's good. But if we see some question marks around about that March rate cut, then we could see some near-term volatility to close out the week.